we're going to be launching right back into some more deductions. But as we're doing this, we have to say, okay, let's think about how this works, since we're kind of thinking with our tax return minds, and say some of these pass-through entities, they may be existing at like an S corporation or partnership level. How does this work out? We know that we have to create those K1s, and how does it pass through onto those K1s? They have to use their percentage in this calculation. So if you have two shareholders in an S corporation and they both own 50%, each shareholder is going to have to worry about 50% of the total QBI. It's basically, it's flowing through onto the K1, 50% of those W-2 wages, 50% of that UBID. I know it's a mouthful to say the whole thing. And what we're going to be doing then is saying, okay, how does kind of the big picture flow through to the small picture of the individuals? So we would say we have another taxpayer. His name is Sam Venture, and he's a partner in a rental real estate partnership, and we're going to say for these purposes he meets the safe harbor rules and so forth, so that there's not a worry for the QBID deduction. He's single filer and he owns 20%. And he has other income of $102,000 during the year. He's going to take the standard deduction for 2018. And why is all this important? Reality is you've got to do the whole entire tax return all the way down to taxable income before we start worrying about the deduction. So we can start right there and say, okay, income of $102,000, taking away $12,000 standard deduction, we're looking about $90,000 potentially. But then, we got to worry about, we have a portion of the partnership interest. So our $250,000, we get 20% of that. And the partnership, the property is not fully depreciated, and it was purchased for $1 million. Has some wages. So all these are going to be throttled down to 20% is how much he gets of all these business income amounts. And that's going to show up on the K1. So again, why would I show you all this math if our software does that for us, right? We got to be able to do the logic test. If you're looking at somebody's K1 and you know these numbers, you know the total income of the business, and you're like, well, okay, 20% of that should be his. That's the QBI income, and 20% of the wages and so forth. You have a way of double checking this. So if we look at the answers, we have to go through all the paces. We're going to take 20% of this income. We're going to take his other income, subtract the standard deduction. Our taxable income would be $140,000. From there, then we can look at the taxable income limitation and say, okay, just to make sure that we're not going to be throttled down at that moment, $28,000, so 20% of it. What's our tentative QBI? It's his share, his 20% share of this times 20%. And right at this moment, this is kind of amusing for me that I did structure it this way. I'll have most everybody else trying to fill out the rest of that wage and capital testing worksheet. And you have to stop for a second and say, wait a second. Our total taxable income is less than we have to worry about doing all this testing. We don't have to even worry about all that. We got all that information, but we don't have to worry. Our tentative QBI deduction is less than it's not being limited by income, so we get the full QBI. So that's just a little catch when you're doing those, this is the answer key ultimately, but that would be what often trips us up, as we forget that if we're below that phase out limitation, 157.5, we got it easy. We get the full deduction. As we look at Sam Venture, and we're going to just change his percentage of ownership, and the same sort of fact patterns. So we're going to say maybe a little bit more income. We kind of get the idea how this works. 60% of his partnership interest. The property that he has isn't fully depreciated, $1 million of property, some wages. What happens here in this case, his taxable income is dramatically different. So now, guess what? We do have to do the whole entire calculation. So we start with the taxable income limitation. Just make sure, 20% of that isn't going to throttle us too much. We're okay because the tentative QBI deduction is less, so we could potentially get it all. It just depends how the rest of this math is going to work out. His wage test, 50% of, because we can use either two directions, so it's basically 50% of his portion, 60% of his wages. His 50% test would equal $33,000 after you do those couple steps of math, or the wage and capital test. So it's 25% of his portion of wages plus 2.5% of his portion of the UBID. An adjusted basis of the property is 31.5. Now here we can choose the bigger two, we don't want to use the 31.5. If that's the lowest number, we would use 33. And that's basically what we get. Because we have to do wage and capital testing and it doesn't produce more than what we want, we're throttled down to whatever that number is, the bigger of the two. So our QBI deduction in this example would be $33,000. SAM Venture, again, if we do the same thing, but we're just tweaking basically percentage so we can kind of see how all this works out when it flows through. 40% partner in the venture. Other income of $182,000, again, takes $12,000 for his standard deduction. His partnership generates $100,000 of QBI, but in this case, what we're going to change up, actually, we're going to change up all the numbers. Property is not fully depreciated yet, $80,000 of W-2 wages. So doing the same thing, taxable income, it's over thresholds. We got to start worrying about that. Testing. Taxable income isn't going to be a really worry there. Our tentative QBI, $8,000, because if we look at 40% of his portion of the partnership times 20%, it doesn't really generate a lot there. If we look at our other two numbers, our wage test and our wage and capital test are more, well, that would be great. But in this case, we only get to use the QBI. As long as we have more than that tested out, we get to use our QBI. That's tentative. We don't ever get to bump it up higher than 20% of our qualified business income, but that just shows you what happens if your wage and capital tests produce higher numbers. That's great. And then you do get your full QBI. Looking at another way to tweak it, just to help settle this in just a little bit more. Again, the same thing, but he's just 25% owner. We're changing his income up a little bit. Is changing the partnership in what we're going to say is property is fully depreciated, the mortgage is paid off completely, and they purchased it for $1 million. And all they did is replace the major appliances in this particular one for $8,000. It's in 2010, so if we fast forward, we're like, okay, cool, it hasn't been 10 years yet. We can use that. We get $8,000 for our qualified income immediately. Basically, we look at our $8,000 as the portion of it, and 25% of that, by the way. So that's how much our property value is, and he doesn't have wages. So that's something to hold on to so we can see some extremes. Taxable income, just doing the same things as before. It's not going to be limiting. So our tentative QBI deduction, it's 25% of his partnership interest times 20%. We get potentially $10,000. That's what we're hoping for. But we don't have wages. And by the time we take 25% of this times, 2.5%, wage and capital test, $50. How much QBI could he take? $50. Now, I want to just throw this example in here because I have a word of caution. Along with all these rules, they threw in a little tiny thing that changes our understatement penalty provisions. It's kind of innocuous, it's kind of hidden, but if you go through an exam and they say, oh, you understated your income, that threshold used to be 10% before you get hit with that penalty. If you use the QBI deduction, it drops it to only a 5% threshold. So it's much easier for them to tack on understatement penalty. So the question would be, do you really want to do it for $50 deduction? By the time you work all that out and say, I'm getting just a few dollars of tax savings, maybe I don't want to do that. So then the question would be, can you override your software to say, thanks, but no thanks. This is great, but I really don't want it because I don't want to go ahead and increase my risk for this particular year for a few measly dollars. So it is something to think of. That is a little hidden nuance to it. If it is worth it, it's always worth it, but yeah, you got to look at the dollar amounts here. In this case, it also gives a very good example. If you don't have much invested, doesn't matter what your potential deduction is, it's going to be throttled down if your income is too high. So taxable income always we do first in order to determine if we're going to be having to do these other tests. So that is the main takeaway. Now when you go backwards in the slides and you look at the flow chart or you look at a couple of those other things that we did initially, you'll be able to follow that flow chart and say, you know what, this finally does make sense now. And the main thing, most of your taxpayers are probably not going to be over that income threshold, so all that wage and income testing, not a worry. We're going to go ahead and make sure you get full credit for sticking along for today. I hope that now the calculations are making sense. I really encourage you to go and play with the supplemental information, those worksheets, because it absolutely will help to make it make more sense. And I also threw the flow chart in there as well for you. So thank you so much for tagging along, and I'm going to turn this over for making sure you get a poll question today.